Welcome to this explainer. Look, right now, the Federal Reserve is locked in a massive fight that they honestly cannot fully win. And your wallet is literally sitting right in the crosshairs. So today, we're taking this incredibly tense standoff and translating it into plain English. We're going to strip away the complex economic jargon, dig into the raw data, and show you exactly what all of this means for your mortgage, your savings, and your future. The math behind their most recent decision is pretty wild. Back on July 29th, the Federal Open Market Committee delivered this incredibly rare 9-3 divided vote to keep the federal funds rate steady. That 9-3 split, that is a massive deal. It's just exceedingly unusual to see three regional Fed presidents completely break ranks at the exact same time to push hard for a rate hike. I mean, the tension inside that committee room is so thick right now that the new Fed chair, Kevin Warsh, actually came out and publicly called it a family fight. That one phrase, it really tells you everything you need to know, right? The consensus at the very top of our financial system is entirely fractured. Okay, so here's our roadmap for this explainer. 1, boxed in by inflation. 2, the case for hiking. 3, the case for holding. And 4, your wallet's bottom line. All right, kicking things off with section 1, boxed in by inflation, how the Fed got trapped. To really get this family fight, you've got to look at the timeline. In late 2025, you'll remember the Fed was being super proactive. They cut rates 3 times to cushion a cooling job market. But then, well, they hit a total brick wall. Across 5 straight meetings in early 2026, they just sat on their hands. No cuts, no hikes, just waiting, because inflation absolutely refused to drop down to their target. So now they're caught in the ultimate economic trap. On one hand, you've got inflation being fueled by Middle East energy tensions and fresh tariffs. If you cut rates, you're just pouring gasoline on that fire. But on the other hand, major growth risk. The labor market is already showing some visible cracks. If you hike rates to fight that inflation, you risk breaking the jobs market entirely. They are quite literally completely boxed in. Moving on to section 2, the case for hiking, steel manning the hawks. 5 years. That is the absolutely crucial point for the hawks here. Inflation has stubbornly hovered above the Fed's 2% target for half a decade now. Their argument is pretty straightforward. You just cannot call a 5-year problem temporary anymore. It's structural at this point, and playing nice with interest rates, well, it just isn't cutting it. You know, even officials who ultimately voted to hold rates steady are absolutely terrified of repeating the 1970s. Back then, the central bank backed off way too early, inflation completely dug its heels in, and it poisoned the U.S. economy for an entire decade. Chair Warsh has even noted that inflation is a choice, basically implying the Fed has the heavy machinery to crush it if they just have the stomach to actually use it. For the hawks, this whole thing boils down to credibility. It is their single most valuable asset. If everyday Americans and, Wall Street traders stop believing the Fed is actually serious about that 2% goal, panic sets in. Prices spiral simply because everyone expects them to. And at that point, any future rate cuts become completely useless. All right, section 3, the case for holding, steel manning the doves. Now the doves anchor their case in a labor market that is barely treading water. Plus, they make a really fair point that today's inflation is largely driven by international tariffs and energy disruptions. Think about it. Raising interest rates to fix an international tariff is kind of like using a hammer to fix a leaky pipe. It's just the wrong tool. You're basically just penalizing everyday Americans without actually solving the underlying supply chain problem. Adding even more weight to the doves' argument is the bond market itself. Long-term borrowing costs are already going up naturally. I mean, the 30-year Treasury yield recently pushed past 5.1%. And what does that actually mean? It means mortgages and corporate loans are getting more expensive entirely on their own. The free market is already doing the heavy lifting. So the doves argue the Fed doesn't need to step in, hike rates, and risk doing unnecessary damage. Which brings us to section 4, the Warsh curveball, a new era of unpredictability. So we have to talk about forward guidance. That's when central banks drop those heavy hints to the public about their next move. During the Powell era, the Fed played with its cards face up. But Warsh? He's completely abandoned this. By refusing to tip his hand, he's keeping the Fed's options entirely open on a meeting-by-meeting basis. The result? A super high-stakes guessing game and a massive spike in market volatility. And finally, section 5, your wallet's bottom line, what this means for your money.
Okay, so before you make any major financial moves, you really need to keep your eye on 3 massive puzzle pieces. Step 1, track the incoming inflation data. Step 2, monitor the labor market. Because honestly, if jobs weaken, the doves win. But if inflation runs hot, the hawks win. And step 3, circle September 15th and 16th on your calendar. That FOMC meeting is going to feature the highly anticipated dot plot, which will finally reveal exactly where officials see rates going by the end of the year.
So, let's break this down into plain English for your wallet. If you're a borrower, maybe hoping to buy a house, definitely don't hold your breath for any massive rate drops. 30-year mortgages are staying elevated for sure. Now, if you're a saver, you're actually in a golden window right now. You'll want to lock in those high-yield savings accounts and CDs immediately while they're sitting at the top of the cycle. And if you're an investor, brace for some serious chop. With a divided Fed, markets are going to be jumping at shadows. The big takeaway here is don't overreact to a single headline. The Fed is definitely no longer fighting inflation in a vacuum. They are walking a razor-thin tightrope. So as we look ahead to September, it all really comes down to one defining question. Will the Fed prioritize your job security, or will they willingly break the labor market to finally crush the ghost of 1970s inflation once and for all? The era of predictable money is officially over, and we'll be watching